The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Buying tech and fading cyclicals amid a heavy slate of Fed speak and economic data. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
And I'm Alex Steele. What am I going to say?
I don't know.
56.
56?
56 record highs on the S&P, 41 for the NASDAQ 100. And again, the narrative is it's driven by tech. The Mag 7 index hitting a record high led by Amazon as well as Netflix. The S&P around up by about 0.5%. We're off the lows of the session, but nonetheless, it's still a pretty powerful rally. I do want to point out, though, Romaine, that the two-year yield getting a nice bid after all that Fed speak, and Jay Powell also talking about getting slowly but confidently more to neutral.
Yeah, and on that point, we had a ton of Fed speak today, including, as you just said, from Fed Chair Jay Powell, just getting off the stage not too long ago and providing maybe a little bit of a tinge of clarity, at least on the economic mindset of monetary policymakers as they head into their next rate decision, which is actually just 2 weeks from today. But Jay Powell's challenge is really going to be to find consensus among FOMC members who still seem split on the pace of rate cuts. Here's St. Louis Fed President Alberto Muslim speaking just this morning at a Bloomberg event.
Along this baseline path, it seems important to maintain policy optionality, and the time may be approaching to consider slowing the pace of interest rate reductions or pausing to carefully assess the current economic environment.
And while that economic environment, while largely sound, is exhibiting some degree of strain. You had a new ADP report showing employment growth soft in the leisure and finance industries, a monthly ISM survey of business conditions in the services sector showing expansion slowing for the first time since June. And you had a somewhat chilling earnings report out of Foot Locker, which cut its sales and profit forecast because of decreased consumer spending into the holiday season. You want to see the flip side, obviously. And that calls into question the wisdom behind that rotation into small cap stocks. Bloomberg's chief equity strategist, Gina Martin Adams, saying be selective there. She still favors small cap financials, utilities, and communication names, but says she's shunning discretionary and industrial stocks in that small cap space, positing that the Russell 2000 has pretty much priced in much of the Fed's anticipated rate cuts, which leaves upside surprises on revenue growth as the only hope for a sustained rally in that space, Alex.
Yep, Bank of America calling a small cap trade like waiting for Godot, right? You always want it to happen. And this is one of the reasons that they actually say why. This looks at a rate cut, market expectations of a rate cut for December as well as January. The purple is for December, the yellow is for January. And you can see the re-rating that we've done so far. We're looking at January 2025, about a 6 basis point cut and about a 19 basis point cut then for December. So it looks like we'll get the cut right in December, but the January then really is the question, which circles back to that Russell 2000 call, right? Because if you don't have as many rate cuts as we were once expecting, what does that do to the refinancing risk for the Russell 2000? Because we're not going to get another 6, cuts from the Fed as markets kind of re-rate at this point. Yeah,
you're really seeing that reflected in the swaps market as well. Let's kick you off to the close here on this Wednesday afternoon with David Bahnsen, the Chief Investment Officer with the Bahnsen Group. And David, I feel like we've obsessed so much about the Fed and rates. Look, we're probably going to get some cuts. I don't know whether we're getting 6. Should the market really be as laser focused on this? I know it factors into cost of capital, blah, blah, blah. But aren't there other things really driving this market right now?
Absolutely. And I think 2024 is a screaming claim of what you're saying. The expectations were moved all the time and markets kept going higher. And every time they recalibrated, it made no difference in risk pricing. The markets know that the Fed's not going higher. The markets know they are going lower. The exact magnitude and the exact speed is totally irrelevant. Corporate profits and the valuation around those profits. That's what's going to drive markets. We're assuming 14 to 15% year-over-year earnings growth, and we're paying 22 to 23 times for that. Mm-hmm. That's what the market pricing is about, not the Fed funds rate.
I am curious about the valuation side of things. Just a couple, yesterday or the day before, I believe, one of our Bloomberg anchors caught up with Aswaf Damodaran, NYU finance professor, a value guy, who was actually saying, look, yeah, historically, valuations are high, but he was making the case that valuations aren't nearly as stretched as maybe what those numbers look like on the top line.
I've read a lot of those arguments, and that's a very qualified person to make the case, but I want to be real clear. Every time someone starts talking about this time it's different, it never ends up being different.
Yeah.
Ever. It's just a matter of when it ends up reverting to the mean.
Yeah.
And those that are saying it is not as bad as it was in 99 with Cisco and Juniper, that's true. There is far more revenue and far more earnings growth than they had then. However, it is still deeply stretched, and you can use any metric you want, your price to perfection. At some point, when some quarter comes, when order flow disappoints on something AI related, you have a significant possibility of downside.
I mean, we've seen that in the last 2 summers. We've had a little bit of a tech swoon, and then the money comes in and continues to buy it, whether that's like mechanical buying or retail and FOMO, right? So how can you stand against that?
Because it ends at some point. They cannot continue to go through the trees. And also the denominator now is $3 trillion of market cap. So to add $300 billion to the market cap of NVIDIA, you're only going to get 10%. A lot of people think they're going to get another 40, 50, 100%. And now you're talking about trillions of dollars of market cap.
But it's not just NVIDIA, right? It's not just the Mag 7, like Salesforce, for example, on real numbers at a record high today, for example.
Yeah.
So how do you get the boost without taking on the risk of the more frothy names?
You don't, and that's why I just simply believe it's not a good time to be a cap-weighted index investor. Even Salesforce would be probably Mag 10, Mag 15. I mean, it's not by any means a medium capitalization name. It's still quite large, but it isn't Mag 7. But I think when you're talking about those right now, financials and energy have done extremely well since the election, and no one's talking about it. Their performance has been bigger than that of the tech space. So that's a good thing for the market that the breadth has come out a bit. But no, I don't think that into next year people can be expecting the same move that you got in 23 and 24.
I am curious, though, when we talk about on the sector level, and of course financials have had a pretty good run since the election, I think up about 8% as a group. They were doing well before that, as you know, energy as well. A big part of the bullish case for both of those sectors seems to be the potential for deregulation, or at least a lack of aggressive regulation that maybe we saw over the past 3.5 years or so. Are you buying into that?
Yes, but I would be bifurcating in energy between midstream and upstream, and in financials between asset managers and banks, because it's a very different story, and we consider it all one sector, but it's really two totally different stories. Yeah. When you look at M&A picking up, when you look at a lower cost of capital, you look at higher margins, these private equity companies, we own Apollo and Blackstone and Blue Owl, they benefit. Net interest margin is the story with the JP Morgan. They have M&A, it's a good franchise there, but the bank story is different than the asset managers. We're huge midstream investors, and I can't come up with a bad thesis on midstream.
Can I push back on that?
Sure.
And I'm going to do my best Jamie Dimon impression, because he would push back on you as well and tell you that basically he's going to just keep buying the stock hand over fist. When you look at the banks, and let's just separate the real gems, like a JP Morgan, if you will. You can even maybe throw a Morgan Stanley in there as well. The cash generation there is phenomenal. Huge. And I feel like every year we get these calls that say this is the end of it, of the run, so to speak. We're going to start to see some real hiccups and bumps here, and they continue to defy those expectations.
Well, and by the way, those are the exact two names that we own, is JP Morgan and Morgan Stanley. And the big banks and Morgan Stanley is kind of a wealth manager and asset manager. It's the dividend that tells you what do they believe is going to happen on their own future free cash flow generation. JP Morgan and especially Morgan Stanley have become big dividend growers. JP Morgan, we bought around $25, 2009. They've grown the dividend 10 times. And the stock is up 10 times. Morgan Stanley has the largest dividend in the financial sector. So when the companies are voting with their yield, I think you can have more confidence. I would not feel the same about Citi and Bank of America, certainly not Wells Fargo.
Okay, so is that your play for midstream? Because we know that MLPs have nice dividends, but that has some political risk. And I appreciate we have a new administration, but they just got 4 years to remove risk in terms of, say, inciting new pipelines.
Well, yeah, but the issue there is that the pipelines go up in value when you're not building new pipelines.
So you like the fact they're not building?
Yeah, look at it. It's up 25% per year since Biden was president. So the midstream sector either benefits from new terminals, new export LNG, new pipelines being built, or it benefits the older companies. What it is the difference between small cap and large cap. We like the large cap companies when they're protecting incumbents. Now, hopefully, you can get some growth in the space. You need more pipelines being built.
All right, David, always a great conversation, always great insights. David Bahnsen, the Chief Investment Officer at the Bahnsen Group, kicking us off to the close here on this Wednesday afternoon as we turn our eyes over to Europe and a historic vote of no confidence in France, upending the European country's government. A closer look at the impact to one of the largest and most important economies in that region.
Plus, Needham saying that Roku is ripe for the taking, why a new note points to the streaming video platform company as a takeout target.
And we're still on retail watch and earnings watch as well, combining after the bell with results out of Five Below, American Eagle, and a few others. And of course, that comes on the heels of a chilly forecast from Foot Locker. A full breakdown of everything that's going on with the health of the consumer right here on The Close on Bloomberg.
Marine Le Pen's far-right party teaming up with a left-wing coalition to topple the French government in a no-confidence vote, ousting Prime Minister Michel Barnier. President Emmanuel Macron also expected to speak tomorrow night. Joining us from Morris Bloomberg, Stephen Carroll, who joins us from Paris. What happens now?
So the government of Michel Barnier has to present their resignation after losing that no confidence vote. So that leaves it up to the president, Emmanuel Macron, to nominate a new prime minister. There's a clock hanging over this, though, because France also hasn't passed a budget for 2025, which means the current one runs out at the end of this year. And although there isn't a US-style shutdown on the cards, it does place all government departments and government services in sort of minimum service mode. Taxes will still be collected, welfare benefits will still be paid, but it makes it very difficult to govern or to do anything differently from what's done now, and certainly to tackle the tricky budget deficit issues. So what we need to hear is what Emmanuel Macron wants to do next. There have been calls for him to resign from some far-left parties, not completely a surprise, they've said that before. Marine Le Pen says she will consider whoever the next prime minister is nominated by the president, but it's very difficult to see who he can pick that might be better than Michel Barnier at bringing together such a fractured French parliament. There's three large groups, none of them have enough seats to be able to govern. There's nowhere near a majority to be found. So some sort of temporary coalition has to be cobbled together, and it's not clear who could do it.
So I'm looking at the difference between French spreads and what we're seeing over in Germany, and you're looking at like 83 basis point difference. When you talk to investors, is that enough to reflect the political turmoil that we are indeed seeing?
We've come off a widening. We got to 90 basis points of a spread at one point between those 10-year French and German yields. That's the widest that we've seen since 2012, when we were in the height of the Eurozone crisis. There was even a moment during the week where France's borrowing costs matched Greece's on the 10-year, which caused a lot of consternation. But what investors are telling us is that, look, they've priced in this move now, and because there isn't an immediate cliff edge, because we don't know what's going to happen next, and things will sort of rumble along for the next couple of months, if that's how long it might take. There's no shock in store for investors right now. They have already reacted to the idea that this budget won't get passed. That's been on the cards for a while. Yeah. We've been building up to this moment when Barnier could have perhaps have been rescued, but that didn't happen, and the sword fell on him.
Well, I am curious, Stephen. I mean, we're still awaiting to hear from Macron. The raw reporting says that he has a speech planned for tomorrow evening in France. I am curious, though, about the alternatives to Barnier. Like, who could Macron put out there? What is the speculation of the types of people that he could put out there that would manage to make it through a vote?
Look, if you look at the parliamentary maths, you'd be inclined to think that Emmanuel Macron will be looking at the Socialist Party, the centre-left party. They have a history of being in government. They came back after the last election with many more seats than they had previously. That would be a pretty hefty chunk of in numbers that you could bring into a centrist coalition if you picked someone from those ranks. He did try this the last time around. He talked to Bernard Cazeneuve, who's a former socialist prime minister. He's one of the names that perhaps could be in the fray again. Last time around, because the socialists are part of a wider left-wing alliance, they put the kibosh on the idea. They wanted to go with their original candidate, who's from one of the harder left parties. But perhaps what Emmanuel Macron will be trying to do now is appeal to that centre-left party, which, by the way, includes former President François Hollande, who got elected during the parliamentary elections in July. So, you know, perhaps François Hollande could be convinced. He said no up until this point, but, you know, the offer could be pretty strong.
Yeah, I got to do a little arm twisting there. Hollande, a blast from the past. I kind of forgot he was still around. Stephen Carroll, our man in London, now our man in Paris, keeping a close eye here on the collapse of the French government and a big decision by Emmanuel Macron scheduled to address the nation at some point in roughly the next 24 hours. Meanwhile, back here in the U.S., Alex, as you know, we're dealing with our own political and governmental changes, if you will, here. And one of the big sort of parlor games was who was President-elect Trump going to pick to run the Securities and Exchange Commission? And we now have an answer to that.
Paul Atkins,
Atkins
will be doing that.
Yeah.
And it seemed to be relatively market positive. Terry Haynes over at Pangea said market positive because he knows policy and he knows he has operational expertise. And that combination could be really bullish for that area.
And you combine that, of course, with the announcement about the Deputy Treasury Secretary. And despite some of the other cabinet picks that have raised a lot of questions about suitability, it does appear that at least when it comes to Atkins and a couple of the other financial related picks and economic related picks, definitely more palatable to the markets.
Yep. And what we know about him is he doesn't really love regulation, and he likes fintech, and he likes digital assets, and he doesn't want too much regulation holding everything down. And
you saw that reflected in some of the movements in both the bond market and in crypto once those headlines cross the terminal a little bit earlier today. All right, when we come back, we're going to talk about what Netflix, Amazon, and Trade Desk all have in common.
Oh, I know this.
It could be the potential buyers of Roku. No, I love Roku. Leave it alone. All right, we're going to talk to an analyst who actually says, well, here's what could happen. That's part of our top calls, and it's coming up next right here on The Close on Bloomberg. All right, let's get a view from the sell side. It's time now for our top calls. These are the big movers on the back of analyst recommendations. And we're going to start off today with telehealth services. Mizuho today actually starting coverage of companies like GoodRx and Talkspace, giving the latter, Talkspace, an outperform recommendation and a $5 price target. The analyst says Talkspace has become profitable, driven by growing demand for mental health care here in the U.S. And this says that the company is on track to achieve its long-term guidance metrics through 2026. Those shares having a decent day, up about 4%. Next up, Broadcom, HSBC, initiating coverage with a hold and a 160 target. The analyst, Frank Lee, says the chip manufacturer faces potential headwinds from decelerating revenue growth at its VMware business, as well as the potential loss of wireless market share. Nevertheless, the share is getting the modest bid on the day, up about 1%. And finally, M&T Bank, a downgrade today to neutral from overweight over at JP Morgan. This is mostly a valuation call, to be sure. The analyst not seeing any catalyst right now that can actually add to the stock's 54% run-up this year. Phenomenal for a bank of that size. He also says the bank's earnings outlook is solid, but expects exposure to office real estate to remain a headwind. Those shares down about 1% on the day. And those are our top calls. Let's switch gears from banking to the wonderful world of streaming. Shares of Roku soaring. Needham suggesting that any company willing to acquire the streaming service could strike gold. The analyst behind that call joins us right now. Laura Martin is senior entertainment and internet analyst at Needham. She has a buy rating on the shares. And Laura, I love Roku. And one reason why I love it, because it's kind of like the Switzerland of streaming. It's kind of everything to everybody. No one really owns it. I knew it was too good to last. Do you think it's really realistic that we could see a meaningful bid come in for this company sometime soon?
I do. I think Walmart has told you by buying Vizio that these large retailers need to have a connected television advertising platform to tie purchases to. And that's what Amazon is doing right now. And now Walmart has followed. That means Target and other large retailers have that reason to buy Roku, to tie Roku's connected television ad units to their sales in their retail stores. By the way, Roku has much higher margins than any retailer. Secondly, Trade Desk, which is a large advertising company, has said it's starting an operating system. It's almost impossible to build these now. Roku has 85 million installed base of operating systems in consumers' homes, watching 4 hours of TV a day. And I think Amazon is the best purchasers here. Why? Because these large language models like Bedrock, owned by Amazon, or Gemini, owned by Alphabet, are running out of data points to feed them. And Roku has 85 million homes watching 4.5 hours a day. So they have a lot of first-party data. And Amazon could tie the advertising of Roku to purchases. So there's a lot of potential purchasers here.
So put a number on this for me, Laura, in terms of valuation. I know you have a $100 price target on the stock, but we're talking about a stock that at one point during the pandemic was around $500. It's around 83 now. A buyer comes in. I mean, where's kind of the general price point?
So super voting shares of the founder here, Anthony Wood, you must convince him to sell. So my gut feel is this stock goes for 100% premium over, it's sort of probably a 50% premium from here because it's up on these acquisition rumors both today and on a couple notes yesterday. So I think it will go at a 50% premium to this, but you must get Anthony Woods to sell. He controls the company absolutely.
So if it doesn't happen, though, can Roku continue growing at the same kind of pace and then increase its valuation at the same time?
It can. It can grow fundamentally. It's just that I think with Republican sweep of Washington, D.C., I think a lot of media needs to consolidate in this 4 years because the regulatory agencies will have Republican heads and they tend to be more open to acquisitions and consolidations, and media industry must consolidate.
But do you think that the administration would consider Roku tech or media? Because not necessarily a straight line that all, say, tech companies would be approved for M&A.
So I think big tech, we'll see how Republicans handle big tech like Amazon and Alphabet. But it's my opinion that Trade Desk would be allowed to buy Roku, and Target would be allowed to buy Roku, and Netflix would be allowed. There's plenty of companies that are small enough that Roku's only a $12 billion company today. So even at 100% markup, it's a $20 billion company. That isn't big compared to $3 trillion for Apple or $2 trillion for Amazon. So I don't think many of the purchasers for Roku would not have any regulatory issues under either a Democrat or a Republican.
Is there any issue, though, too, with this idea that Roku kind of was able to grow primarily because it really wasn't kind of affiliated with anyone? It could kind of sort of bring in content from all the different platforms, if you will, to a certain extent, obviously. I know it's kind of branched out now a little bit more into creating its own content and having some exclusivity. But does that hurt it? I mean, if it does sort of move, I guess, a little bit more into the proprietary intellectual property space?
So the answer is it has an installed base of 85 million homes. And so therefore, that the data it gets is really valuable. So I don't think it needs to grow as fast going forward as it has in the past. And its strategic value is really valuable with the onslaught of generative AI. Also, remember, it got very lucky with COVID because a lot of people bought 2 and 3 televisions during COVID, many of them Roku sticks or Roku televisions, because suddenly you didn't want to share TV time with your 15-year-old when you were locked in your house for a year. So we've gotten this huge installed base bump out of luck for Roku. And now that Walmart has bought Vizio, Costco and Sam's Club are kicking Vizio TVs out because they don't want Walmart to have their data as the largest competitor. So they're letting Roku TVs come and take that shelf space. Again, lucky.
Such a good point. You're right. My Little Ponies. It was too much during the pandemic of that. All right, Laura Martin over at Needham. Yeah, you jealous? You jealous?
Yeah, we didn't have that.
Twilight Sparkle. Anyway, Roku stock at the highest level since the middle of February, rallying the most at one point since November of last year.
Yeah. We've been. I was an early adopter of Roku. I really loved it before. I ended up having to do the whole streaming bundle, which is basically a bundle now. But I always loved Roku for what it.
I would like it to be a bundle. It'll be cheaper that way. Go figure.
You got Roku.
All right, coming up, Chris Ailman, founder and CEO of Ailman Advisers, giving us his outlook for the market for 2025. This is Bloomberg.
Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostic.
And I'm Alex Steele. You got the Russell 2000 up by 0.3%, but I was really interested by the note from Bank of America today that called Russell 2000 waiting for Godot. Like, we keep waiting for it to be really good. It's waiting for it to outperform, and yet it doesn't really.
Yeah, I mean, we get these bouts of optimism for those small cap and cyclical names, and then you get what happens this week where everyone just says, you know what, let's just go back into big tech, go back into the Magnet 7. And we heard from, I really just don't want to belabor it, but, you know, that whole commentary, the interview that has Linda had with Damodaran, you know, ultimate value guy, basically saying he finds value in some of those big cap names. He finds value even in the aggregate index, despite the fact that, at least on a historical basis, it's probably overvalued.
And then if you kind of layer in the incoming Trump administration, that's where sometimes the Russell 2000 gets its bid, in that we're going to have less regulation, it's going to be lower taxes, that's going to be good for the Russell. But there are other factors surrounding it, like if we don't get as many rate cuts. But a lot of CEOs are feeling pretty optimistic about the incoming administration.
Have you seen some of the data that we've gotten, some of the business sentiment data? It's all been positive, and it's all been significantly higher than what it was prior to the election. You go back and you look at some of those surveys from August and September, and then you compare what we got in those surveys from October, November, and now here in December.
Which begs the question, is the rally that we're seeing in the continued record highs actually something more fundamental that can continue then for next year? Chris Ailman, founder and CEO of Ailman Advisers, joins us now. Hey, Chris, it's great to see you.
Good to see you.
New role, new job, new gig, your own thing. It's great to have you.
Thank you. It's wonderful to be here again. I really appreciate it.
So what do you think is going to happen for 2025? Do we have these fundamental drivers that are actually going to keep building on momentum, or are we going to halt?
The fourth year of a president's term, no wonder the economy is strong. The big mistake was it's strong too late. And what surprised me is, look at this year. The market is up 28%, one of the biggest bull markets. So reading Bloomberg on Monday had a great article about the fact that the number of new highs this year, historically, that does not repeat the second year. A market up 28% in 1 year does not usually repeat. So I'm done predicting markets. I'm retired now. But hey, I have to say the market on odds would be have a tougher year next year. And if you're a non-U.S. investor, you hit right on it. Outside the USA, when you invest globally now, the U.S. is 2/3 of the world market.
Right.
So you're concentrated in the U.S. And in the U.S., you're concentrated in these tech names. And that's a real problem for global investors. How do they diversify? They like small caps, but you can't move away from them. If a value investor is even finding value in these large cap names, well, come on, it's because they're up so big. You have to own them, otherwise you underperform.
Right.
Challenging year, and there are a lot of risks on the horizon.
Right, and also if you want to go to value, are you going to Europe? I mean, Europe has a whole host of problems. We just saw French government falling, right? I mean, maybe the UK is a stable place.
No, emerging markets. Emerging markets, they're cheap. Wait, they were cheap last year, the year before, the year before,
and look
the
at
year
South
before.
Korea.
And look at South Korea. Geopolitical risk. You've got two major wars. The Fed probably is stopping after this. Another quarter, they've lowered rates 1%. Bonds still have an option, and I think people don't rebalance their portfolio enough. Right now, this time of the year is a great time to look back. People are way overweight tech, way overweight stocks, and we've learned a lesson. Things don't run to the moon. They average up over time.
I am curious, though. I mean, on the terms of the portfolio allocation, and you talk about the overweights in stocks, obviously still crowded, but also we keep talking about all this cash on the sidelines, which is, I don't know where these sidelines are, but the cash is there apparently, and it's not moving. And,
it's all mine.
And you don't, well.
Lucky that guy.
Yeah, well, look, you don't need to move it, do you? I mean, like if you're getting 4.5%, and I know that's 4.5 isn't 28% or whatever we have in the equity market, but yeah, as you know, it's all relative. It's based on, you know, your risk levels and things like that. And there are a lot of people, they just want slow and steady returns that they can count on that outpace inflation.
Hey, slow and steady is the rabbit wins the race. We already know the story. You don't have to be, I'm sorry, the turtle. The rabbit, rabbit doesn't win. Don't chase short-term returns. Go for long-term returns. A steady return of 5 to 7%. Your money is going to compound in a decade, and that's awesome. But with 28%, people want to chase with Bitcoin at these kind of levels. People want to chase crazy returns, and they will continue to do short term, and I think that's going to hurt them in the long term. You want to be a nice balanced portfolio.
But on the issue, though, of whether this rally, the stock rally, continues in 2025, there's been a lot of people also pointing out that first-year administrations typically, new administrations, you typically see
historically
softness in the equity market. But there seems to be a certain euphoria around Trump's election, primarily because most people seem to think there will be a deregulatory atmosphere, certainly not the regulatory atmosphere that we had under Biden. And more importantly, the idea that he's actually going to be a champion for certain things like crypto and Bitcoin. Do you buy into that? I mean, we got a new SEC chair. I mean, he's not there yet, but we know who it's going to be. Most people, the market seem to be reacting favorably to that.
I think the market reaction is investing in the rearview mirror. They look at the past 4 years he had, and it was a bull market. Different market coming into that environment in 16 and different economy. The Fed was at zero and barely raising rates after the great financial crisis. So I think really now you've really got to take a look at that first year term. There's going to be a lot of changes. Things aren't the same.
Right.
He's going to care about the stock market. So I doubt we're going to have a traditional bear market, as we would call it. But I would expect after a market to run out of gas. Tech is going to do well, but you've got to diversify. You can't just be in these names.
But with his cabinet picks, or at least the ones that are economically and financially focused, and other advisors in that space,
the one with experience in their area.
I mean, do you have confidence that they will be good, at least be good stewards of the economy and markets in a way that might sort of extend this rally?
Yes, because the president, as last time, measured his success by the stock market more than any other past president. He quoted it. So I think there's generally, and I think the systems are going to be good. The systems are still in place. Unless this Doge group wipes out parts of government, and who knows what's going to happen there. But, you know, I said last year, any president that won was going to be facing a huge budget crisis in that the interest on the national debt is eating up a third of the budget, more than defense. They're not going to be able to balance it. They're going to grow the deficit again. But you've got, you know, people in his party who don't want to do that. So I don't necessarily think it's just going to be a cakewalk. And I think we're going to see some challenges for them in the implementation phase. And we're already hearing from CEOs what they don't like is the regulation whiplash. On, off, on, off. They'd rather just give me a consistency to 5 to 6 years so I can manage into that.
Is the new 60-40, 60-40?
I think that, honestly, no. I look at my mother-in-law, and I can't talk Betty out of 90% stocks. And I look at my son-in-law, who is in his 20s, who doesn't want to be 90% in stocks. So I still think 70-30 makes sense, 80-20. But right now in America, there is cash on the sideline, but people are 80 to 90% invested in this market and in the large cap tech names. You were talking earlier about cap-weighted indices. I love indices, but the problem with the MSCI and the Russell Index, you own the winners and you're underweight the losers. Warren Buffett would say, do that backwards.
All right, Chris, great to see you. It's been too long. Chris Ailman, who is now the founder and CEO of Ailman Advisers. Great perspectives here on the future of these markets. Meanwhile, some breaking news on Intel. I remember all the drama earlier this week, Alex Steele. Well, Intel has now said, speaking at a UBS tech conference, executives are saying that for now they are going to stand by the financial guidance that they gave on that most recent earnings report here. Obviously, maybe a little bit of comfort here as they try to find a new path forward here with new leadership at in the CEO suite.
Yeah, that stock's still down by about 2%.
Yeah, absolutely. All right, a lot more coming up here on the program. If you think that stock is down, well, don't look at Foot Locker. Those shares falling after reporting earnings. But more importantly, it was about the forecast cut on both profit and sales, and interesting commentary about the health of the consumer. Apparently not so healthy heading into the holiday season. That's coming up next right here on The Close on Bloomberg. Welcome back. Let's take a look at shares of Foot Locker, down 10%. Worst one-day decline since August, down to the lowest level since May. This after cutting its full-year sales and profit forecast. And the company didn't mince words. The consumer is choosy, picky, and smart. Those are the words of new CEO Mary Dillon. Abigail Doolittle joining us right now to talk a little bit more about what's ailing Foot Locker heading into what should have been a pretty decent holiday season. They're basically saying it might not actually shape up as decent as I think some people thought.
That is exactly what they're saying, and they put their money where their mouth is in terms of bringing the guide down for the full year 2025 comp sales, and of course for the retail that ends in January. So it's basically this final quarter here of November, December, and January. They brought it from a range of up 1% to 3% to up 1 to 1.3 or 4%.
Yeah,
the street's
gotcha.
at 1.6%. That's a massive guide down on the high end. And something that I would say, we were just talking about it, is I was actually out shopping yesterday in Westchester in a rather affluent area. I was in 3 or 4 different stores, and they were literally empty to the point that I do not recall ever, whether it's holiday season, January, where there's typically not shopping, or summer, where there's not a lot of shopping, seeing stores so empty. I mean, I was in a massive Saks Fifth Avenue, off Saks, and the store was me and maybe 3 other people.
And this is in suburban New York.
And this is in suburban New York, where there, a pretty, not that I live in this area
pretty
exactly.
Affluent
yeah,
area.
pretty affluent area. And
gotcha.
I was thinking to myself, what's going on? It actually felt as though everybody had already done their shopping. Now, there is the possibility, of course, that I think you're in a good place to be. I wish I were where you're at.
Yeah.
That, e-commerce, Amazon, other online retailers. On the other hand, you have Jay Powell today basically indicating the economy is in good shape, but we continue to have these mixed reports out of retailers. So the story, the picture remains inconsistent.
Well, that's why I'm wondering how much of it is idiosyncratic to a Foot Locker versus other names, because you do get other read-throughs from, say, like a Dollar Tree or like a Walmart, for example, or a TJX that is very different from what, say, Foot Locker is describing.
Well, it's interesting that you're saying this, Alex, because it does seem to be store by store. I mean, Target, they just had a hard time. Dollar Tree, up until this past quarter, they're having a hard time. That store stock down about 50% on the year. So it seems to be store by store, different consumers. I mean, I think one of the bigger macro points that we have on consumers that's interesting is that Walmart has continued to see quarter after quarter higher income folks going there for deals. So when you have higher income folks looking for deals, it suggests that maybe things are a little bit tighter. I mean, we are in this period of big inflation.
Well, I'll also push back. I thought there was a story on the terminal from the data from the National Retail Federation actually showing that this was a pretty weak coming out of that Black Friday into Cyber Monday, relatively weak. I don't know all the numbers, but I think overall is about down about 1.7%.
But also you have to look too. I feel like the deals start before too. So I wonder if we can't just do 72 hours. We have to do like the whole month of November or something.
Well, that's what I'm curious.
Reshaping.
Yeah, well, that's what I'm curious about too. Whether we get to when we get a better look at the holiday shopping season,
we'll really
whether
figure out.
you need to kind of change the start date a little bit rather than just trying to peg it to.
So you're done with your Christmas shopping?
Pretty much, yeah.
Me
I think
too.
I have like one person that I have to get something for.
Yeah, no, same for me, which is not surprising because we're both very type A people.
Yeah.
But but for the point, like we didn't just shop in the last 24 hours. Like we've been on it. All right, Abigail. Thanks a lot. Abigail Doolittle joining us there for that.
Yeah, we be shopping.
Maybe shopping. Like he's an ad there, but whatever. All right, we're about 15 minutes away from the close of trading. I'm going to say it looking like we're going to see another record high for the S&P this year. That would be 56 record highs, 41 record highs when it comes to the NASDAQ 100. And you have the Mag 7 also at a record high. Kara Murphy, Chief Investment Officer at Kestra Investment, will be joining us. This is Bloomberg.
There's a set of institutional relationships between the Fed and every administration. I fully expect that we'll have the same general kinds of relationships that we have, institutional relationships, for example, with the Council of Economic Advisers, but most importantly with the Treasury Department.
The chairman of the Federal Reserve, Jerome Powell, speaking a little bit earlier today at the New York Times Deal Book Summit. Of course, a lot of speculation right now, Alex Steele, about the pace of rate cuts. Of course, a big meeting, rate decision 2 weeks from today.
Yep, but that not really denting anything when it comes to the equity market, right? Whether or not they're going to go one and then pause or one and then another one in January, you're still seeing record highs in the S&P, in big tech, the NASDAQ, the Mag 7, the S&P Tech Index, Salesforce, you name it. In the tech industry, it seems to be doing really well. Now, the question is, does that hold up? And who's actually buying behind that? Is it mechanical funds or is it real people?
But it kind of makes you wonder, too. I mean, I know we focus on tech, and you see the S&P record high, NASDAQ 100 record high. The Russell, believe it or not, perking up here, only about less than 20 points from its record high. And you have an MSCI All World Index at a record high, and obviously the U.S. Contributes a big chunk to that. But even if you take the U.S. out, everything's doing pretty good.
But then Bank of America says small caps are waiting for Godot. And also, I hate waiting for Godot, so I really appreciated that analogy.
Yeah.
You can never get any love in the small caps.
Yeah, I remember reading that in high school, and I did not get it. And my English professor was very upset with me for some
Beckett,
reason
move
or
on.
another. So I don't know where he is today, but if Mr. Fackler's out there, hello. All right, let's keep it moving here and continue to count you down to the closing bells. Just about 8.5 minutes to go with stocks now nearing session highs. Kara Murphy joins us, Chief Investment Officer at Kestra Kestra Investment Management. And Kara, today we've been focusing a lot here on the health of the consumer, particularly on the back of some of those retail earnings we got this morning, as well as some key retail earnings that we get after the bell. And when you put it all together, I'm not sure you're getting a very consistent and cohesive picture. I don't know if the consumer is healthy or not. And how much should we be concerned about whether that's going to feed or maybe detract from the rally?
Well, I think you point out some of these contradictory pieces of evidence that we're getting. And I think on whole, the consumer remains really healthy. But we've gotten very contradictory evidence for quite some time. You know, if you look at consumer confidence surveys over the last year or so, many consumers are saying that they don't feel really good. In fact, some of those surveys suggest that consumers feel as bad today as they did going back to the great financial crisis. But then when you look at spending, consumers are out there in aggregate actually still spending money. Wages are still increasing fairly well. The labor market remains fairly tight, even though a lot of workers are saying that they're discontent in their jobs and looking for additional jobs. So on balance, I think you've had a consistently sort of pessimistic consumer, but one who's acting like they feel pretty good in their pocketbook. Mm-hmm. And I think ultimately what we'll see this holiday season, which was always very critical for retailers, is that consumers are out there spending. They might be spending in slightly different ways. And so that might be what we're seeing with, Foot Locker and other types of companies that maybe don't have as rosy kind of outlooks on the holiday season, but it's being made up for in other ways. People are moving to e-commerce, other types of products. Yeah.
Well, how does that feed in, though, to actual buying discretionary stocks? Because I was looking at the performance of discretionary names, and discretionary stocks have largely outperformed as a group, certainly over the past month and even over the past 3 months. But the complexion of that is way different. When you look at the last few weeks, it's been a lot of retail names, apparel names. Maybe that's a function of it being close to the holidays. When you look at the gains in the discretionary sector 3-4 months ago, it was a lot of services stuff, cruise lines, hotels, travel, essentially, here. What am I supposed to make of that?
Well, I think you're right in that we're seeing a lot of noise start to come in with this holiday spending as people start to shift spending, as we get more towards the holidays away from services into particular goods. I think there's also a little bit of pull forward effect with people anticipating tariffs. So big ticket items they might be putting in today in order to avoid that potential tariff. So you're going to naturally see a little bit of noise, but ultimately it's going to be driven by how healthy are consumer pocketbooks and how strong are their balance sheets. And I think both are in pretty good positions.
So then how do you distinguish with large cap tech, say mid cap, and then small cap? If we just go back to what's really powered the overall rally with the S&P up, 28% this year. You got Mag 7 at a record high right now. You have Amazon, you have Netflix. And I'm wondering, do you reduce exposure when you're at those record highs now and put it somewhere else, or do you barbell?
So if you think about it, ultimately, over the medium to long term, stocks are going to go by earnings growth. And even with this incredible performance among the Mag 7, they've had really strong earnings growth that's helped underpin that rally. Everybody else in the market hasn't had really great earnings growth. Now, as you start to move into next year, that picture really changes. So the expected earnings growth rate of some of those Mag 7 names starts to slow, and the expected earnings rate of everybody else starts to pick up, so that by next year, you're closer to parity. Right. So I think what that means is you don't sort of ditch the Mag 7 completely, but you have to start to make sure that you have exposure as you go down cap. And I've often said you don't have to go all the way down to small cap. You can just go to smaller, large cap and mid cap, and you can still sort of diversify out that exposure and have exposure to some of those names that will start to be building earnings momentum into next year.
Yeah, I was going to say, so are mid caps kind of the sweet spot? Basically.
I do. I think mid caps are really interesting because you have a lot of the same things that you have in small cap in that they've been sort of ignored. They don't have a lot of focus on the sort of institutional side. PEs are much more attractive, but those tend to be a little bit better positioned balance sheets, not as beholden to like a single area. A little bit more diversified. So I think it's a bit of a safer way to play this, and you can take a little bit more time for that to play out. When you're looking at economic conditions here in the U.S., market conditions here in the U.S., Kara, you have to factor in, of course, what's going on overseas as well. There are always ripple effects. A lot of geopolitical risk out there from issues with the government in South Korea, issues with the government, of course, today in France, ongoing military conflicts in the Middle East, Ukraine, and God only knows what's going on in China. How much do you model that in to your forecast for U.S. assets? It's interesting because, I've been in this business for a really long time. And whenever I talk about potential risks, geopolitical risk is always on there, right? So there are always issues that are sort of brewing outside the U.S. They don't often get to a level where it starts to impact the U.S. focused consumer. It often happens through oil, right? That tends to be the typical transmission mechanism. That said, it does feel like geopolitical risk is starting to rise. And I think you mentioned a lot of them. In South Korea, we've had all of that political turmoil, but this comes on the heels of a lot of saber rattling at North Korea, right? And certainly continuing conflict in Ukraine and Russia and the Middle East. These are all things that feel like they're starting to step up. And you pair that with a new administration here in the U.S., one who's decidedly isolationist, maybe a little bit more difficult to predict how Trump is going to approach foreign policy. So I think you have to tick up that possibility of higher geopolitical risk going forward, but it's still not to the level where I would be heading to the hills.
All right, Kara, great stuff. Kara Murphy, she's the Chief Investment Officer of Kestra Investment Management, counting us down to the closing bells just about 2.5 minutes ago. Alex, still right around session highs for the major indices.
It was interesting to get a couple notes today from Nomura as well as Scott Rebner over at Goldman Sachs, talking about mechanical buying and then also the FOMO and how they're kind of feeding into one another at the end of the day. And the question is, how long does that last?
Modest buying in the Treasury space, a modest bid to the VIX. A full breakdown of all the market coverage starts now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Alex Steele, taking you through that closing bell, a global simulcast. It starts right now. Scarlett Fu here in the TV studio, Tim Stenovic in the radio booth, Emily Grafeo filling in for Carroll Massler today as we welcome our audiences across all of our Bloomberg platforms, including our partnership with YouTube with an S&P 500. Tim Stenovic at a record high.
Another record high. I think 56
is
56. The number for the year. But it's not a very broad-based rally. It's pretty concentrated in consumer discretionary and tech. So, not broad-based, but still what? Up 0.6%, Emily. Nothing to shake a stick at.
No, and volatility is very low. We have the VIX at a measly 13 right now, as I guess people are just ultra bullish on stocks. No fear on Wall Street.
They're ultra bullish, even though the eco data has been coming in somewhat mixed. You look at ISM services, which disappointed. And if you look at the Eco Surprise Index, which tracks how often data points come in better than expected, it peaked in mid-November and has kind of been, plateauing since then. But the S&P 500 up almost 4%, and the Russell and the NASDAQ up about 5.5%.
Which then raises a question, like, is everything too awesome? And if you're dealing with sort of funds buying into the end of the year and then some FOMO in the retail market, does that wind up then reversing, say, in January and February, based on the economic fundamentals?
Interesting to see discretionary stocks as well as some of the software stocks getting a strong bid today, seeing some weakness out there right now when it comes to home builders, as well as a lot of the commodity stocks as well. Yield slightly lower here on the day, and we talk about a dollar. They had been exhibiting some pretty decent strength, unchanged here on the day. Bitcoin higher by 3%. As far as your equities goes, we get the closing bells here in New York being rung over there at the NYSE by Deckers, and over at the NASDAQ by Robinhood on a record day for the S&P and the NASDAQ, 37 points higher on the S&P to 6,086 and change, up 0.6%. The NASDAQ composite up about 1.3%. The Dow Jones Industrial Average above 45,000, up 0.7%, and the Russell 2000, which has been oscillating between gains and losses, finishing higher by 0.4%.
Romaine, you can finally go and get that pair of Hokas you've had your eyes on.
No.
You swing down to the New York Stock.
I can never respect anybody who wears Hokas. Sorry, Tim.
All right, just me. And then, hey, you actually had fewer stocks in the S&P 500 move higher today. 232 stocks advanced, while 270 declined, despite the fact that the index did move higher. Speaks to the stocks that did move higher, which were the large market cap names.
And with the S&P and the indexes really climbing to session highs near the end of trading, we saw more sectors finishing in the green than perhaps just 10 minutes ago. Tech, consumer discretionary and communication services, those are your big techie sectors leading the advance. But you also have positive marks for industrials and utilities. The big laggard here on the day is energy, losing 2.5%.
All right, let's talk about some of the stocks that did move higher. I got the gainers today, and we got a record for Salesforce, higher today by 11%. We can go ahead and round that up, closing at its highest ever, 367.87. Salesforce shares hitting a record. The company reported that better than expected quarterly revenue. Look, for decades they've been selling this CRM software, but they've pivoted to this AI strategy. They're focusing on these agents. They're designed to complete tasks such as customer support or sales development without human supervision. Investors are certainly happy what they heard on that call yesterday. Taking a look at shares of Amazon, which today rose in the wake of the company's reInvent Cloud conference. Analysts said underscored its potential with AI. Shares higher by 2.2% today. Investors certainly liked what they saw. Here's what we learned over the past couple of days. Amazon stringing together hundreds of thousands of its Trainium 2 semiconductors into clusters that are going to make it easier for Anthropic to train the LLMs that are required for Gen AI and other machine learning. Shares higher by 2.2%. I think we're still getting earnings, Romain.
Yeah, this involving Five Below. Of course, the big headline, though, out of Five Below is that they have actually found a new CEO. Remember, their last CEO left earlier this year. They've been with the interim CEO since. We're now learned that Winnie Park has been named the new CEO over at Five Below. This comes on the back of some of their earnings that are out. Comp sales in the most recent quarter, a surprising gain of 0.6%. The street was looking for a drop in comp sales of about 4.4%. So a big beat there, though EPS is a big miss. EPS coming in at 3 cents a share. The street was looking for 17 cents a share. And here's your forecast going forward. The company's saying net sales, I'm just going to give you the full year number, 3.84 to 3.87 billion. That range is higher than the previous range that it had of about 3.7 to 3.8, Alex.
Yep, so they wind up guiding a little bit higher than what the street was estimating. And also, it just really pairs to the point of the retailing signal is very confusing, right? You have Foot Locker getting hammered, Deckers closing at a record high, and then Five Below coming in quite strong with that new CEO and that guidance boost. So it's not a straight line when it comes to the consumer, that idiosyncratic story coming out to play here.
I'm just looking through the press release, and they're talking about solid Black Friday weekend results, encouraging start to the holiday season, but the highest volume selling days still lie ahead, and how overall they were pleased with overall strong performance and operational execution. That's going to be key. That's about managing your inventory.
And I was just looking through Winnie Park's resume here. She was most recently at Forever 21, but she used to be the CEO of PaperSource. I still love PaperSource.
Really? PaperSource is so expensive, though. It's like $800 for a card.
Yeah. Well, she's got a long history in this business, including working for things like Dockers, Levi Strauss as well. So it looks on paper like she's got a pretty good qualifications for this job.
All right, well, that stock is higher, but I am also looking at some decliners. Scarlett had mentioned energy down, and Texas Pacific Land Corporation was the worst performer on the S&P 500 on the day. Biggest intraday drop since March 2020. Oil and gas stocks more broadly are falling as tepid U.S. economic data raises concerns about crude demand. Traders also seeing negative technical momentum on oil after WTI failed to hold above $70 a barrel. We're talking about retailers. Foot Locker was down as much as 20% today. It did pair some of those losses, closing down only about 9%, but still pretty rough for this stock. They cut their full year sales and profit forecasts due to increased discounts and decreased consumer spending ahead. Not a great mix for a retailer. The company's CEO, Mary Dillon, attributed the decline to consumers becoming more frugal and seeking better deals. And then finally, Shift4 Payments, the biggest drop in that stock since April 2023, falling as much as 13% after President-elect Donald Trump nominated the company's billionaire founder, chairman, and CEO, Jared Isaacman, to serve as NASA administrator. Isaacman will stay on as CEO until the nomination gets confirmed. We saw a downgrade over at Bank of America on that stock, ticker 4, again falling about 13% today.
Okay, back to retail and earnings. Shares of American Eagle Outfitters down 6% in the after hours. The company coming out with numbers. Third quarter net revenue coming in just shy of estimates. I mean, barely shy of estimates. 1.29 billion. Estimates were for 1.3 billion. American Eagle third quarter adjusted EPS coming in at 48 cents. Estimates were for 46 cents. Third quarter adjusted EPS did beat estimates. Still, shareholders in the after hours sending shares down by 9%.
All right, I'm taking a look at synopsis here. On the surface, the earnings actually came in pretty solid. Earnings coming in at about $3.40. That beat estimates. Also, revenue coming in at $1.64 billion. What I'm scratching my head here, though, is when it comes to their outlook for the first quarter. They're looking at a range on earnings from $2.77 to $2.82. That's coming in pretty strong. And then you also have adjusted revenue for the first quarter on the high end coming in at 2.82. I'm going to assume that that's billion. for earnings, and then for revenue, 1.47 billion on the high side. That looks a little light compared to estimates, so I'm going to have to read in a little bit on that. That stock down 8%.
Yeah, just looking back at the American Eagle, because the retailers always do give us a good read into the consumer. Their CEO said that the company was led by a strong back-to-school season, achieving comparable sales growth across brands and channels, and delivered adjusted operating income at the high end of our guidance range. But still, that stock down almost 9%. That net revenue missing estimates coming in only at 1.29 billion. Versus estimates of 1.3 billion. So not too much of a miss, but a miss nonetheless.
The company saying that inventory up about 5%, a healthy level according to it, right around 804 million. We're still awaiting some earnings out of additional retailers. That includes PVH Corp. Of course, what is that? Lee Jeans, if I remember correctly.
Also, that's not
Calvin Klein. Thank you to our producer for updating us on that. But it gets to this idea of what people are buying this holiday season. I don't know. You raised this issue earlier, Alex, when we were talking about Foot Locker, whether that is just an idiosyncratic story, because Foot Locker was, of course, struggling long before this holiday season, or is that indicative of a broader trend in retail right now?
Yep, exactly. And then you're going to see the bifurcation versus just sort of a big sweep. Like I mentioned, Deckers, say, closing at a record high.
Or you have to have management that knows how to spearhead a turnaround. You look at Abercrombie & Fitch, for the past year, it's gained about 109%. And American Eagle, in contrast, up 4.6% over the past 12 months.
Wow. Can't pretend to understand where the trends are going.
Remember when once upon a time they were kind of interchangeable?
Yes.
Yeah.
That's not the case
I thought
anymore.
they were the same. It was like Abercrombie & Fitch. What was it? Hollister.
American Eagle.
What was the other one? I don't know. A bunch of
Anthropology?
Aeropostale. Yeah, all those places. Yeah. Look at us. Trip down. Emily's like, what are these old people talking about?
No, those were my stores.
As I'm sure Emily will now tell us. But, I think it does raise the question when it comes to tariffs, too, how they wind up managing their inventory if we have any tariff issues that wind up coming on, and sort of how their inventory outlook is for the first half of next year.
Nobody knows what's going to happen with tariffs, not even the Federal Reserve. As we heard from Jay Powell a little earlier, they're trying to model what's going to happen, but it's a little too early to do that. Hey, that is going to do it for our cross-platform coverage of the market close, our simulcast with Bloomberg TV and Bloomberg Radio right here at the close. We'll see you all same time, same place tomorrow.
All right, don't go anywhere. A lot more coverage coming up on Bloomberg Television. We're going to take a deeper dive into the retail space. We're going to take a closer look at the Trump administration, which just announced its latest appointments, including a new SEC chair that really could shape how the markets perform over the next few years. That's coming up next, right here on The Close. This is Bloomberg.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostick. Scarlett, you like record highs?
Love record highs.
Well, you get a record high. You get a record high. Everyone gets a record high today. The S&P 500 up 0.6%. That slow, steady climb for a 56th record high of the year, powered by what else? The Mag 7. The Mag 7 as a group at a record high. The NASDAQ as a group at a record high. Apparel companies as a group at a record high. In fact, everything's pretty much moving higher here on the day. Bitcoin not quite at the record high, Scarlett, but making its way there as well. I guess there is still some optimism in this market. Maybe it's because of the economy. Maybe it's because of earnings.
Well, let's continue with the record highs because we also have Salesforce and Marvell closing at, you guessed it, record highs. Salesforce was the best performer in the S&P 500, up 11%. Marvell gained about 23%. And this is really looking beyond the Mag 7, where the AI narrative is boosting software companies like Salesforce and chip device companies like Marvell, both closing at those record highs. The optimism that AI will continue to boost demand for their products. No record high here for Foot Locker, down almost 9% on the day. It did fall as much as 20%, so this is well off its lows. It cut its full-year sales and profit outlook, citing a pullback in consumer spending, increasing the need for more promotional offers as well. So that leads us into our top story this hour, which is more proof that American shoppers are becoming more selective about their spending. New data show that fewer people shopped during Thanksgiving weekend this year. And an estimated 197 million people bought stuff online and in stores in that 4-day period. That's down 1.7% from last year's record of 200.4 million. So we'll be reporting on the latest earnings from retail brands. And later in the program, we'll be speaking with the CEO of artificial Christmas tree company, Balsam Hill.
Absolutely. And before we get deeper into those retail earnings, we do get some earnings out of, I guess, the techie space. Sentinel One out, of course, security company. Those shares down about 9% in the after hours trade. Revenue coming in line with estimates, up to around 211 million. The street was looking for roughly 210 here. On the revenue side, on the EPS side, basically there was no EPS. It was basically unchanged here. The street was looking for a posting of about 1 cent a share. And the guidance going forward, the full year revenue guidance, $818 million. The company had previously seen revenue of $815 million. The street looking for $816, so slightly higher on that forecast. But clearly, based on the price reaction, investors are looking for something a little bit more, Scarlett.
All right, let's take a look at ChargePoint because the movement there is very different. The shares are jumping in after hours trading right now. This is the EV charging network company, and the stock up 14% right now after fourth quarter revenue looks like, or I should say third quarter revenue beats analyst estimates, 99.6 million, so just under 100 million, beating the consensus estimate by about $10 million. As for the fourth quarter revenue, it sees it from $95 million to $105 million, whereas analysts were looking for $101.3 million. So certainly at the higher end, it tops the average analyst estimate.
All right, we go back to retail and a tale of two cities here. Five Below, one of the best performing stocks in the after-hour trade. They just reported earnings here, a beat and raise and a new CEO replacing the interim CEO. And then American Eagle, one of the worst performers here in the after-hour trade. Relatively decent beat in the most recent quarter, but maybe some concerns here about bottom line EPS and, more importantly, the guidance going forward. Also, we're getting results right now out of PVH. This is the company behind Calvin Klein jeans here. Just taking a look here at the wires. The shares are moving slightly to the downside on a knee-jerk reaction to adjusted EPS in the third quarter of $3.03 a share. That is a beat. The street was looking for $2.59. Revenue, though, coming in at $2.26 billion. The street was looking for $2.2 billion. And the full year adjusted EPS forecast, the range, $11.55 to $11.70. That's a slight narrowing of the range that they had given before of 11.5 to 11.8. Here, the share is slightly down in the after-hours trade by 4%. Let's get right to Deborah Weinswig, CEO over at Foresight Research, who keeps a close eye on what's going on in the retail space. And we just got PVH, but I want to go back to American Eagle because I'm a little curious about the market reaction that we're seeing there. I know they missed on a couple of key metrics here, but when you take a look at the broader landscape of how we're shopping, what we're buying, and more importantly, whether those trends are sustainable, do you actually see some hope that these mid-tier retailers like American Eagle have some extra life in them?
Yeah, I think as we heard, first of all, absolutely. And I think that what we saw in the last quarter is this idea that they're leaning more into some of these micro trends, whether it's on TikTok or other social media. And sometimes, right, that'll take a bit of time to play out. I do think we saw strength in the third quarter. And I do agree. I think their guidance for the fourth is let's chalk it up to conservative.
It gets to this idea, though, too, is what is the consumer right now? I feel like there's just so many disparate opinions about the health of the consumer. And I feel like we have to break it down, not just in terms of financial demographics, but obviously age and even regional. I mean, there's got to be major differences here. And maybe that's why we're getting these distortions and disconnections.
I couldn't agree with you more. I mean, we are obviously seeing Gen Z with, kind of unprecedented spending power. They are starting to drive a lot of these trends and, really kind of tipping the balance for a lot of these retailers. One of the things we did see across kind of Black Friday weekend was that mall traffic was strong, but traffic into specific retailers was weaker, I think, than expected across the board. And so you are getting people out. They do want this sense of community and shopping, but they are being, let's just say, picky in terms of where they shop. And social media is definitely a big part of that.
I'm curious about what you think the next generation of CEOs for retailers need. I mean, we're in this mode where there's a lot of transitions going on, and the CEOs are going to need to manage their supply chain in a different way, especially if these tariffs do come to pass in the next couple of years. How do you marry that with the savviness that they need to be as merchants, picking out the right product selection and making sure that they roll out the products at the right time?
To me, supply chain is truly the most important aspect for these retailers right now, and I think going into the future. And, we are seeing production, I would say, moving geographically, which can be challenging. There are concerns about tariffs. We also don't want retailers to overreact to that ahead of, official news. And thirdly, this idea around, right, your lead times are really critical right now, going back to this idea around these micro trends and being able to lean into them and getting back into business. I think that, one of the reasons that we're seeing Five Below so strong in after hours is with the naming of their new CEO with Winnie, right? And she's got a lot of strength and a lot of history in doing great things in supply chain. So I think that is making a difference in terms of who's named to those roles. And, if we look back at, American Eagle and PVH, American Eagle has also showed a lot of agility in supply chain. And one of the reasons I'd lean into that retailer as well.
All right, good stuff. And thank you for folding in the new CEO over at Five Below. So having said all that, what kind of CEO, who's an example of a CEO who has figured this all out? I mean, are we still looking at the CEO of Abercrombie and Fitch, there we go, as the model CEO that we want for 2025?
I mean, what's amazing that Fran has done is I think that they really understand Gen Z. And they understand how that consumer shops differently than millennials. And if we go back and look at their most recent quarter, right, you saw over 50% of millennials shopping online and over 50% of Gen Z shopping in store. And they've really figured that out. And I do think there's a magic in that. And it's really staying data driven. I think there's a lot that can pull CEOs in many directions, but being very data driven in decisions and having it be more science than art, even though we're in retail, it is very difficult. But I think, folks like Fran, folks like Doug McMillon, right, at Walmart, that is what is really driving, I think, a lot of the strength. And one of the reasons I would say with Five Below, I stayed the course there, is you had the co-founder step back in as exec chair, and he's been guiding the ship, right, with some of the changes in the executive suite. And so that, I think, is what's really exciting right now. But yes, CEOs with focus on data and supply chain, that's what's going to win here.
Deborah, really appreciate your joining us. Deborah Weinswig is CEO at Foresight Research. And just to recap here, PVH and American Eagle shares are lower in after-hours trading, and Five Below is higher.
We're going to get back to some of those earnings a little bit later in the show. But when we come back, we do want to bring you an update here on that stunning situation here in the pre-dawn hours in New York City. The killing of Brian Thompson, the United Health Group executive, a manhunt underway for his killer. We're going to discuss that story when we come back after the break. This is Bloomberg.
The motive for this murder currently is unknown, but based on the evidence we have so far, it does appear that the victim was specifically targeted. But at this point, we do not know why. This does not appear to be a random act of violence.
And that was the New York Police Department's chief of detectives briefing reporters earlier this afternoon on the fatal shooting of United Healthcare CEO Brian Thompson. Joining us now with the latest on this developing story is Katia Porzecanski, our New York bureau chief. So, Katia, this took place almost 10 hours ago in Midtown Manhattan, a short distance from our global headquarters here. What is the latest development?
So, police have recently released more footage of both the attack and of the suspect, including photos that were taken before the attack at a Starbucks nearby, which has a clear image of him, and though he is masked and he's hooded. And they're trying to find out, purchases. There was the city bike that he took. Did he use a credit card to get the city bike? And they'll slowly piece this together, right? If he's left any other evidence behind.
But he's still at large right now.
But he is still at large, yes.
There's obviously a lot of questions about motive, questions that I'm sure you can't answer, and it'll be a while before the police can answer them as well. However, when you piece together what the police have told us happened this morning, it's about 6:45 a.m., they seem to be pretty certain that this was a targeted attack and not something that puts the broader public in danger.
Precisely, and they're calling it premeditated. If they're in the image, the video that was released of the attack, you can see He emerges from behind a car. Brian Thompson is walking into the hotel on a side entrance. So there are multiple entrances to the hotel. So you have to have known what entrance he was going into.
Yeah, and just put that in perspective, because I mean, I'm familiar with this hotel, but for our viewers, this hotel almost basically takes up almost a whole square block.
Yeah, not the whole square block, but it takes up certainly like half of the block.
But there's like 3 different blocks you can enter.
Precisely, the north, the south, and on the avenue.
Right.
And he's coming in from the north, and then the Ziegfeld Theater is across the street.
Yes, yes.
And that's where the suspect goes into, and the suspect again emerges from behind a vehicle. He shoots him in the leg and then the chest, and there are other witnesses nearby that run away.
And just to be clear, too, I mean, this happened at 6:45 a.m., but we should point out in New York City at 6:45 a.m., particularly at 6th Avenue and was at 55th Street or wherever it is. It's pretty busy. I mean, this is not an area where there would not be witnesses, even
it's
police.
Rush hour, essentially.
There's actually somebody standing right near him who escapes when it's happening. I mean, it looks extremely targeted. His wife, or his widow, has told NBC News that they had been receiving threats. But Minnesota police, where he's from, did not say that is necessarily. They said that there were no reports of threats.
So Brian Thompson was the CEO of United Healthcare's insurance division, and the parent company United Health Group was holding Investor Day, a big gathering for analysts and investors at that Hilton Midtown hotel. What is United Health saying about this?
Right now, there's not a lot of information from them at all, other than saying he was a beloved person. He'd been at the company for 20 years. I think what we're trying to figure out if this is indeed true that there were threats on him or on any other executives. His wife had mentioned something about, potentially disgruntled customers or something like that. Yeah. And it is interesting that he didn't have security, which, we have reported about how other companies provide security for their CEOs.
It'll be interesting to see how all of this plays out here. Katia Porzecanski, who helps lead our coverage here at Bloomberg out of our New York bureau. And of course, we will await the official words out of the police here in New York, investigating the crime and coordinating their efforts with folks in Minnesota, where Brian Thompson was from, to make sure that they have all the evidence needed to piece together why this happened. And we'll bring you the latest as soon as we get it, right here on The Close on Bloomberg. Marine Le Pen's far-right party, teaming up with a left-wing coalition, toppled the French government. A no-confidence vote earlier today that ousted Prime Minister Michel Barnier. President Emmanuel Macron now expected to address the public tomorrow evening in Paris. Joining us right now is our Paris bureau chief, Alan Katz. And Alan, this was a surprise and kind of not a surprise, but it raises a lot of questions when you consider how short Barnier's term was, and the idea of what Macron can do to placate Marine Le Pen, as well as some of the other folks in that coalition who decided to take this route. What does he do next?
So it's a really hard decision for him, Romain. I mean, it's up to him, first of all. Let's be clear. In the French Constitution, the president gets the right to name the prime minister. Excuse me. And so he has to find somebody who can work with parties, as you said, on the left and the right, Marine Le Pen, who's from the far right National Rally, but also not totally alienate all of those people on the left who also make up a big bloc in Parliament. And that finding that person is not going to be very easy because nobody really wants to work with him. He spent a long time when he had a majority in Parliament really sort of riding roughshod over any objections that other people had, and that hasn't made them very interested in working with him. And he's got a real deadline, or 2 deadlines really, one of which is getting a budget for France. By law, they have to have a budget in by the end of the calendar year, which is fast approaching. They can use sort of some what's called a special law with some decrees that sort of get stuff done for a few weeks and sort of tide it over into 2025. But that really can't last a whole year. They do have to come back with a budget that people, or a majority of people, can agree on. Or actually, let me be more precise, enough people so that you don't get booted out by a majority like has happened to Michel Barnier today. And the other thing he needs to do is he needs to make sure that this sort of drumbeat, which only from the moment exists on the far left, But there is a little bit of a drumbeat, at least on that side, to say Macron should resign, that he's the problem, he should resign. And he needs to make sure he has a government in place so that sort of disappears, that there's something new that's trying to build something rather than sort of, nothing happening government-wise and giving space to people who says, actually, Macron's the problem, he really should go.
Of course, Macron has made clear that he has no intention of resigning before his term ends in 2027. And as soon as he can call elections is not until next year sometime. So that being the case, this is clearly a political crisis. Has it reached a point where it's a financial crisis or an economic crisis?
Not yet. As you point out, he can't actually call new elections for the parliament until July of next year. In France, you can only do that maximum of once a year, and he dissolved parliament last June, and the election actually ended in July, which means it's not until July 2025. So you're sort of stuck with this parliament. And so, as you said, it's created this political turmoil or political chaos, but it hasn't really spilled over into either financial markets or the real economy to a large extent. Now, it has to some extent, right? So the spread between French bonds and German bonds has widened. It's about 85 basis points now. It used to be more around 50 basis points before you first dissolved parliament. So it's widened. But because all of these countries are in the Eurozone, they're all backed by the ECB. That really makes a lot of traders very hesitant to try to go after France in any sort of big way, because it's like going after the Fed, right? Going after the ECB is generally a losing game if you are a bond trader. So it hasn't really happened yet. Yeah. But there's some tensions.
Just real quickly, Alan, we only have about 30 seconds left. I mean, there's been a lot of talk about whether Macron should step aside, but the real big question here is does Le Pen and her party, do they actually have any plan for leadership should somehow this fall into their lap?
So we'll know more tomorrow, because we should be speaking with Le Pen tomorrow, and she was on French television tonight. She talks a game of having a plan, and it's a 5-point plan for a budget. The National Rally has never held national office in France. They've held some mayor's offices, but they don't have any experience, certainly, in really running. France is a reasonably big country. It's about 70 million people, and they don't have any experience doing that. It doesn't mean that they can't, but they certainly have not indicated that they're really ready to run it either.
All right, Alan Katz, really appreciate your staying up late to give us a briefing on the latest in France. We'll check in with you in the days to come. Bloomberg News Bureau Chief, Paris Bureau Chief Alan Katz. Speaking of what's happening in France, you look at the euro, and it was higher, of course, through most of trading. It pared some of its gains, and it's now little change against the dollar. Euro dollar currently at 105, although several analysts are predicting that the euro will fall to parity versus the dollar in the coming months. As for U.S. markets, S&P, NASDAQ 100 closing at record highs. Any gain today really is a record high. 2-year yields coming down about 5 basis points. Jay Powell speaking today, saying the economy is in remarkably good shape.
All right, we take a look at some of the after-hours movers. Two of the big decliners in the after-hour trade. Synopsys on that list, down about 7%. It did see its most recent quarter, the fiscal fourth quarter, EPS forecast missed estimates here, and that's a big part of the reason why you're seeing the drop there, despite the fact that its fiscal fourth quarter numbers actually did meet most estimates here. Meanwhile, you have ChargePoint. This is the big maker of electric vehicle charging stations, posting a loss per share of about 18 cents, which was narrower than the loss per share that it had in the previous quarter here. And it was also better than estimates. That's a big part of the reason why you're seeing that 20% jump in the shares. And Five Below up 11%. Not only decent earnings, but more importantly, they found a new CEO and they seem to like her. Her name is Winnie Park, and she's got a long history in the retail and apparel space, maybe providing some comfort for investors who were concerned about the previous CEO who departed earlier this year. This is The Close on Bloomberg.
The steady stream of President-elect Donald Trump's administration picks continues. Earlier today, Trump announced Paul Atkins, a federal financial regulator, would be his pick to lead the Securities and Exchange Commission. Joining us now with more on this story is Bloomberg's Nicola White. Nicola, what do we expect from the SEC under Paul Atkins, assuming that he is confirmed?
We are expecting major changes. Paul Atkins is well known here in D.C. in financial regulatory circles. He's a longtime public servant, and also he's in the private sector, and he has advocated throughout his career for a lighter touch on regulation. So we're expecting, if not a rollback on certain Securities and Exchange Commission regulations, then at minimum a slowdown on future rulemaking.
And of course, there are a lot of people trying to already draw a contrast between what an Atkins SEC looks like relative to a Gary Gensler SEC. Obviously not a fan favorite among a lot of folks on Wall Street, particularly when it comes to some of those alternative asset classes. You have a sense here that given Atkins' background, Nicola, that we are looking at a situation that will be more market friendly, and more importantly, that he will actually have the support of the market in turn.
Yeah, we're expecting, you have to contrast Paul Atkins with outgoing SEC Chair Gary Gensler, who rolled out one of the most ambitious SEC rulemaking agendas in probably the history of the modern history of the agency. Gensler was sort of known in some circles as, cracking down on everything. And we're expecting that to be a sea change under Atkins. For starters, we're definitely expecting a friendlier touch on crypto. The crypto industry has long decried Gensler's leadership in this asset class. The long time the criticism that has been lobbed at Gensler and the agency is that the agency has led with regulation via enforcement as opposed to laying out clear rules of the road for this emerging industry.
So, Nicola, one thing that we should point out about Atkins is that he served as an SEC commissioner back in 2002 to 2008. So he has a track record here that we can refer to. What did that experience, how did that shape his reputation? What kind of reputation does he have on Capitol Hill in the financial markets?
He has, so exactly right. He has, his record is very, very clear because he was a public servant for quite some time. And so he has, and then after he left the SEC, he was in the private sector. He's testified numerous times in front of Congress. He's been, he's written op-eds, he's been on TV, he's been on podcasts. We know what he believes in. And throughout his tenure, throughout his career, he has advocated for a lighter touch on regulation. One of his big things that he has talked about over the years is he is not a fan of record-breaking fines on companies for alleged wrongdoing. He has said this punishes the individuals and the shareholders that invest in these companies. So under Gensler's tenure, we saw some really, really big fines for companies. Think of all the frauds that we've had in recent years, and the accompanying fines have matched the size of those frauds. So we're expecting to see a rollback in some of those fines going forward for these kinds of cases.
All right, Nicola White down in our D.C. bureau, a closer look at Paul Atkins, the man that President-elect Trump is tapping to be the next commissioner of the SEC. Meanwhile, also on Capitol Hill, members of a Senate subcommittee, they took turns today grilling executives from the major airlines about whether some of the fees they charge are even necessary. Joining us right now to discuss is Tom Fitzgerald, Vice President of Equity Research over at TD Cowen. And of course, always sort of a strange day when you see these CEOs dragged to Capitol Hill. But this, of course, the fee structure and more importantly, the necessity of these fees has been a big topic of conversation. And I am curious, Tom, if we actually learned anything that could actually change the tide and how these fees are assessed today.
Thanks for having me, Raphael. It's a great question. Regulations have been a big focus among investors the last few months. The DOT recently sent a questionnaire regarding loyalty programs, and then obviously there was today's hearing on fees. I think it remains to be seen whether it's more bark than bite, but I do think some of the concerns are a bit antithetical to wanting the industry also to be able to afford large wage increases for their union employees and to be able to fund investments in airport infrastructure and next-gen fuel and new technology, more fuel-efficient aircraft. Mm-hmm. So I think we'll have to see what happens. But as we look out to the future towards the incoming administration, we do expect more of a lighter touch, more collaborative approach. Well, and we also think there should probably be more they'll be a little more amenable to potential consolidation down the road as well.
Well, let's talk a little bit more about that, because we talk about this idea of an administration that most people assume is going to be much friendlier to industries. But we've also seen a lot of signals coming out of this incoming administration that their deregulation approach isn't necessarily going to apply to every single industry out there. There are certain whipping posts out there, I think the airlines being one of them, that I feel is kind of bipartisan in Washington. Is there any hope here that they can escape that type of bipartisan wrath?
I think so. I mean, the industry has been pretty constructive on the nominee to lead DOT, and I think they're pretty optimistic on a less punitive environment in the coming years.
So, Tom, less punitive environment, does that mean something like the American Airlines JetBlue pact that was scuttled by U.S. courts has a second life, that potentially it could come back?
We'll have to see. That's something, JetBlue's talked about wanting to pursue airline partnerships, and, maybe it doesn't come back in the same exact form, and it approaches something more along the lines of the West Coast Alliance that American has with Alaska. But, I do think the antitrust regulation will be less onerous than it's been the last few years.
Okay, so there's antitrust regulation, and then there's questioning the executives on fees, ancillary fees, which can be seen as more populist, supporting everyday Americans' concerns. Whenever you fly, you end up having to shell out another $50 for these random fees. Can you just give us a sense of how reliant these airlines now are on baggage fees, for instance, to flow straight down into their bottom line?
It varies by business model. I mean, the classic ULCC, the Spirits or the Frontiers, they typically were very reliant on ancillary fees to drive their margins, and they would stimulate traffic with a low base fee and then make it up on seat selections or baggage fees. For the larger airlines, your Deltas, your United, they also have their corporate traffic, which tends to be higher yielding. They have long-haul international. They have, these crown jewel credit card programs that drive a lot of the margin. So I don't think they're as reliant on the ancillary fees. But I'd also note that we've seen recently Spirit and Frontier take a more upmarket approach and start bundling options again. So, it was definitely a big disruption in the mid-2000s when this started going across the industry. But I think it's pretty commonplace at this point in time.
All right, Tom, really appreciate your joining us today. Tom Fitzgerald over at TD Cowen covers the airlines for us, for TD Cowen, I should say. All right, still ahead on Bloomberg Markets to Close. It's the season for holiday decorations and spreading holiday cheer. So up next, we're going to talk about consumer trends, the spending of consumers with the CEO of Balsam Hill. It is one of the biggest retailers of artificial Christmas trees as well as holiday decor. This is Bloomberg. Tonight, the Rockefeller Center Christmas tree will be lit here in New York City, and with it comes the age-old debate, real or artificial Christmas trees. According to the American Christmas Tree Association, 78% of Americans will display an artificial tree this holiday season. And our next guest would have to agree. He does benefit from it. Mac Harman is CEO of Balsam Hill. It is one of the biggest retailers of artificial Christmas trees and holiday decor, and he joins us now. And you're in town because you're one of the sponsors of the Christmas tree lighting ceremony. So welcome to New York and welcome to the holiday festivities here. I just want to start big picture here. We talked about 78% of Americans displaying an artificial Christmas tree this season. That's been remarkably
78%?
78%. That's been remarkably consistent, though, since you began the business about 19 years ago, hasn't it?
It has. The first time we got that data from Nielsen, I'm like, we can't share that. No one's going to believe it, that 4 out of 5 households have an artificial tree. But it is the case, and it's in part because of the convenience. People like to put their tree up early, take it down late, and I love real trees, contrary to some public belief. In fact, of course, the tree that we're lighting tonight is a real farm-grown tree. But you should really only have a farm-grown tree in your house for no more than 4 weeks. And so that's one of the reasons artificial trees have been so popular, is you can keep it up for longer.
And you market and you sell, you distribute these premium trees as well. Oftentimes they're $1,000. And I'd like you to talk about the market opportunity when you're selling these kinds of premium products to high-income consumers, because you're selling it to a consumer who often has more than one tree in their house and who often has more than one house as well.
Yes, I mean, it's a great product, especially for people who have multiple houses, because you don't want to have a real tree in a house that you only visit on weekends or just every 3 weeks because you've got to water it every day to keep it alive. So artificial trees work really well for folks with 2 homes. But also, we're actually amazed at the customers who have a lower household income that's stretched to buy a Balsam Hill tree. Mm-hmm. And we find that it's just so meaningful to people emotionally. They really want that. It's a discretionary purchase, but they really want that Balsam Hill tree. Mm-hmm. And so it's just an important part of our holiday traditions. And we see consumers share on Instagram or whatever it is, just the joy that they have, and they've been saving up for it. So it is interesting how people stretch for it. But it's a great market for us across economic levels.
I'm curious about your customer base. Do you get a lot of repeat customers? Because I think about my mother does the artificial tree thing too, but she's had the same artificial tree for I don't know how many years. I don't know what the brand it is, if it's Balsam Hill or not. But there's no reason for her to buy a new tree every year.
So one of the things we're seeing is more and more consumers putting up multiple trees, one in the family room, one in the living room if they do have that space. And then we're also seeing people starting to decorate their foyers and even their kitchens and sometimes bedrooms. And I remember as a kid, I got to pick out, it was my first artificial tree, I picked out a little white Christmas tree that I put in my room when I was 10 or something. I don't know why. So we've seen that for a while, but people just, I think, want more joy, more of those festivities. Especially just, it feels like the world's getting more complicated. And it's just kind of that throwback to something that's familial and comfortable.
Well, let's talk about the complicated world. Obviously, you are reliant on trade, on cross-border trade in order to get your goods made and back here into the U.S. And there's a lot of concern about the incoming Trump administration and the tariffs that could be increased. You already dealt with this once during the first Trump administration, and Balsam Hill came up time and time again in stories back in 2016, 2017. Are you prepared for that again?
Well, we don't know exactly what's going to come, but we hope that our goods are exempted from tariffs because it's a non-strategic good. It's one that's never been made in the U.S. And so, and it comes down to the lights. We spend so much time having our team members wire the lights carefully on the tree. It takes a long time, and Americans just don't want to spend their time doing that.
That's the primary, that's the bigger cost.
That's really why our industry exists, is to have these pre-lit trees and to save us the time of putting the lights on, and instead we can decorate it and celebrate Christmas.
Well, what if the intentions of those tariffs is to bring manufacturing jobs back to the U.S.? Have you looked into what it would cost to, make these Christmas trees at home?
We, back in 2019, started a project to see, can we make these trees in the U.S.? Can we use automation to take the lights out? And there have been advances in automation, but the stringing the lights is something that no one has figured out how to do that with a robot. And so we actually looked at that, and back then it was going to be $3,000 for us to sell a tree that we today would sell at $800. And I just don't think Americans are ready for that kind of price jump. But we have taken actions to move some of our supply chain out of China specifically so that we're hopefully more ready. We just don't know where things are going to go. And one of the things we hope, as I hope as a business owner, is that there's some certainty around where can we invest. As an example, we invested in Mexico, but now if there's a 25% tariff on Mexico, that doesn't work for us, but we already put the capital into starting to make our trees in Mexico. So we really would like some certainty on where is it okay for us to manufacture, because we don't believe we have a product that's going to be made domestically.
All right, Mac, we got to leave it there. Great to catch up with you. I know this is an incredibly busy time of the year for you. A great time, and have fun tonight at the lighting of the Rockefeller Center Christmas tree. Mac Harman there is the CEO of Balsam Hill. With just, by the way, Scarlett, 21 days left for you to shop for Christmas.
I know.
So, just a reminder.
Thank you.
All right, let's set you up.
From the guy who already bought everything like weeks ago.
All right, let's set you up for some of the potential market-moving events that could move the markets over the next 24 hours, and that includes more earnings out of more retailers.
Yeah, Dollar General is reporting, along with Lululemon, Victoria's Secret, Ulta, so it's a real gamut of the retail space.
We're going to get some tech earnings in there as well from Hewlett-Packard Enterprise. Petco also on that list as well. Some interesting names that could shape the trade going forward. We're also going to get some economic data in the drumbeat to Friday's jobs report.
Yeah, jobless claims, high-frequency data point coming out. And, of course, that is the last real big data point before we get the jobs report on Friday, which will help set the tone in terms of how the Fed proceeds next. The trade balance number, which typically we don't pay as much attention to, but with the incoming Trump administration, feels like this is going to be an increasingly important focal point.
We got a lot of Fed speak today. We're going to get more tomorrow, including from Richmond Fed President Tom Barkin. And then, of course, everybody is going to have their eye eyes on Emmanuel Macron, the president of France, scheduled to speak 8 p.m. Paris time. That's roughly 2 p.m. here on the East Coast in New York.
Yeah, he's making his way back from Saudi Arabia. He's been overseas while the political turmoil has unfolded at home.
And that delayed OPEC Plus meeting is going to finally take place tomorrow, so keep an eye on that and everything going on in the commodity space. A lot of potential market-moving events, as Scarlett and I will be here tomorrow to bring you all the coverage for all your political coverage. Stick around. Balance of Power is up next, right here on Bloomberg.